Hello traders, welcome to FreeFX. Today is Thursday, the 15th of October 2015. The topic of today's video is really the use of indicators on charts and in your trading. So, assuming that you know nothing about this and you wanted to inspect some sources or resources on the internet, the Baby Pips website is full of good advice, and more than advice is information that you take away, and it has a school as well. So in this section here, which is middle school, you'll find information about how to use lagging and leading indicators, sort of split into two sections. So you've got things like oscillators and other indicators as well. So we're going to talk about a mixture of these. So you can go and sort of have a look at these, and really there are lots of resources on the internet. Also, try just a Google search for Forex chart indicators and stuff like that. So you'll find there's a lot of good information out there. Another website that I used is the research arm of FXCM, which is dailyfx.com. And I'm just using these. I'm not endorsing them in any way, just really what I use frequently. So, and they do have a lot of educational videos about things like how to use, or videos and articles about different indicators and giving you examples of when they work, but also when they don't. That's really important to bear in mind in our discussion today, is when things don't go according to plan. So I've got a chart here of, well, let's go to currencies, because that's really what this video is about in the end. So this is a chart of Kiwi dollar at the moment. So I'll create a new one actually, just to make it a fresh one. And while I do this, really trying to think why we use indicators is very important. There are two reasons. One is to reinforce the trading bias that we may get from price itself, and two is to really try to get a visual sense of where price is going, rather than looking at price, a naked chart, as they call it. So this is really trying to maximize on the information in front of us in a visual way, as it helps us recognizing patterns that which may be already there, but rather than having to look at a chart again and again, trying to figure it out every time, once we set it into an indicator. Okay, so this is the Kiwi dollar. Now you can see this is a 5-minute chart. We were talking yesterday about trading with a 5-minute chart. So I'm going to give an example starting from there, but I also use a higher time frame, just going to give you an idea of how that changes things using the same indicator. Now, indicators have different functions. For example, what we might use in this case, one that I use frequently, so I can only sort of guess that this is what may be useful to others, but the indicator that I use frequently is the moving average. Now, the moving average is just that. It's an average approximation, really, of where price may be going based on previous movement, and it takes open, close, different price information from a certain period. So in this case, the default is 7 periods. I'm going to change that to, I'm going to make this a 100-day moving average, and I'm going to give it a different color. I'm going to give it a red color. So if I can give it a different color, there we go. That's the red. Okay. Now this allows me to see, there it is, the moving average is the 100 period moving average at the top. So the top here, it gives me the actual price at the moment. So 0.68 is where we're at the moment, 68.40, and price is at 68.64. Now, two things to bear in mind. One, a moving average doesn't tell you where price is going. In other words, at this point here, the moving average is quote-unquote supporting price. So we have this bounce, and it's sort of moved off a little bit. But the moving average on a 5-minute chart is very, very close to the price generally, because it's very sensitive to change, so it reacts very quickly. So it almost engulfs, it's like a glove really, fits very closely to price. Now watching this, obviously we see an uptrend, okay? With or without the indicator, which is a lagging indicator, we see that there's an uptrend going on. And the further back we go, the more we can see how price and the moving average react in different ways. When price breaks below it, then the average is moving with price, starting to turn the other way, and price breaks above it, and it turns again, and it follows price the other way. Now, this isn't particularly useful for giving us an indication of direction and trading clue. So we want to go a little bit higher. So I'm going to jump the 30-minute, go to an hour chart. Now you don't have to add indicator every time. The chart packages normally keep that indicator for you, and also when you log in the next time, we'll have the same parameters. So that's the handy thing. And the other thing is that it will now adjust automatically, keeping the same period. So it will be 100 periods. It won't be 100 5-minute periods. It will now be 100 hour periods. So we're looking at 100 trading hours worth of price. Now you can see how the difference by using the 5-minute and the hourly already. It's a slowly turning moving average. It doesn't quickly react to price the same way. Now you might start using what people call the moving average cross strategy. This is done with either well, there are two ways of using a moving average. When price moves one side or the other of the moving average, that could be your clue. So basically, your signal here would be this. Okay, now you go long at this point, and then you'd be up for a few wins. Let's try to test this backwards. So I'm going to go and select a random point here. Okay, so just kind of I'm going to move it around a little bit so you don't sort of remember what's going on, and see that we're here. Now there's a sort of an uptrend, and we think, okay, I'm going to go long. What is my target? Okay, so let's say you want to risk a certain amount of money, and let's say that you wanted to risk a certain amount of pips based on the position size. So you put together a sort of a risk plan, how much you're willing to lose, how much you're willing to gain, and then you're going to enter. But let's not go into the particulars yet, because I really just want to take this. So let's say that you go long at this point, because you see the uptrend, and you think, ah, yeah, this is really good. So I'm going to go long here. So at this point, based on the fact that the price has been above the moving average, okay, and it's going up, so you're happy with that. Okay, so you go long, and so let's see what happens after that. Okay, still going long. Okay, still going long. Fine. So maybe at some point you had your target up here and it hit it. Okay, let's take a different example altogether. So I'm going to go back. We don't know what's happening to price, so we're not biased. Okay, I'm going to go up a little bit and see what happens here. Now, yep. Okay. Now let's take this point, different point. Now price at this point has moved and crossed the 100-day moving average. This is the hourly chart. So you're trading an hourly time frame and you're looking for a signal like that. So you think, well, this is good. Price sort of closed below and I'm going to go short. So after this candle happens, you're going to go short. Okay, round about there. So just below 0.66. Okay, so let's see if this was a true signal or a false signal. Okay, we're still below. Okay, this was a true signal. We moved down quite a bit. So on an hourly chart, we moved down quite a bit. This, by the way, the 24th of August, I happen to remember, was the so-called Black Monday, although it wasn't the Black Monday of the 1980s. It was the Black Monday of the Chinese market crash. So had you gone short at this point, you know, you see that you probably would have set your target a little bit more conservative, and this would have broken through. But you know, it would have been a good short, and it actually continued there. Now, if you see what happens in this case is that price continues below. So let's go up a little bit because we're happy with that. But let's see what happens on it. That's a little circle from earlier. I'm going to delete that. This is the daily chart. Okay, let's take an example from the daily chart. I'm going to go back a little bit and see what happens at this point. Any signals? Here. Okay. So at this point, price is breaking below. So I don't know what's happening after this. I'm going to put a little circle there. Okay. So at this point, we're about to break below. And the next day, so we're looking at days. So we've gone short here. The next day, price moves below. I've set my target somewhere below this. And sure enough, this actually works because price continues to the downside. So in this case, we moved to 0.77. And we went short around 0.86. because that's 900 pips. Now obviously you may not have set your target to 900 pips. Maybe you went halfway there, 400, 450 pips, maybe even 200, and then you would have maybe gone short again. So the only problem with this is obviously if you went short here and you decided to then put your target, so you went short around here, the crossover, and then you went, your target was 86,543, 300 pips. Okay. This would have been actually filled. Your profit would have been set at 300 pips, and that would have been a great trade. And then you would have gone, well, okay, I want to enter again because the price is continuing below and continues. Now, at this point, obviously, you're quite away from the moving average. It's starting to create a gap there. Can you see how the steep curve here is pulling price away? Now, some people see that as a warning sign. So as you get further out, if you don't get back in quickly, there may be a chance that this might turn around as the gap increases. So let's say that you entered again, you saw another 100 pips down, you enter again at about 82. See this little resistance, so another supply zone, more selling, another 300 pips down, you got out at 79. Okay. So now again, you would have taken another 300 pips, great. At this point, moving average still moving down, price moving down, but you're wondering, what's happening here? So you observe for another 100 pips, and then you think, okay, my criteria say that another 100 pips move in the same direction in parallel to the moving average. I'm going to go short. Had you gone short here at 78, okay, this would have gone choppy, 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 77, and then bounced 76. So 200 pips between your entry of 78 and 76. And then chop, 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 and then again down. But after this is the 21st of January 2015, and you would have gone short around here, okay, 29th of September. So September, end of September, so October, November, December, 4 months. It would have taken 4 months for that order to be filled, okay. So bearing in mind things like negative rollover, because the Kiwi is a higher yielding currency than the US dollar, bearing in mind that you may not set your targets to 4 months into the future, bearing in mind lots of things. You may have either psychologically been worn out by this trade and decided to pull out and take a smaller loss, or wait for it to just go back to below your entry here. Okay, at this point you might have gone, oh, negative territory. Maybe your stop hadn't been set so close, so you might have been okay. Then gone into the green again by 200 pips, and you've gone, well, I'm happy with that. I'm going to take that, not knowing that, you know, if you've gone and taken your profit here, 9th of December, and then 21st of January, you know, it's a month and a half later. So it really requires a lot of patience sometimes for the next big move. So you see, this is quite a big move, because from this bounce from a moving average. Okay, so the other thing to bear in mind as well is the moving average price and moving averages don't always come so close. So what you see is adjustment in time. So the moving averages smooth themselves out in time. So what we might have seen here, so let's go to today, for example. Okay, this is today. Okay, so in time, this will obviously take a curve that may not be exactly, you know, it may just sort of change gradually, and then the relationship between former price and current price does change again over time. So that's why the problem with the lagging indicators like this is that they do kind of give a very convincing picture of price interaction with moving averages being near perfect to the point. But at this time, it may not have been like this. The moving average may have been downtrending, but maybe further up slightly, or maybe further down slightly, and then with time it adjusted to fit price here. So I haven't done a sort of in-depth study of this, but I'm sure that there are, you know, situations that at current price don't happen so precisely neatly as this. At the moment, price has gone through the moving average, so you might want to go long. But then again, you also need to think about creating other strategies if you're going into longer term time frames, which you don't have time for in this video. I'm going to stop here. I hope this has given you sort of a hint as to how you can use a moving average in different situations, different time frames, setting targets, and so on. So thank you very much for listening, and I'll see you for another FreeFX video later on. Thank you.